Well, greetings everybody, and welcome to the May edition of Dashboard Diagnostics. This is our Mother's Day edition, as Lori and I were just sharing. We had this originally scheduled for Mother's Day, and we thought today might be a better idea to stay away from that. A big warm welcome to all of you. My name is Mark Robertson. I'm managing partner and founder of Manifest Investing. I'm joined here by Lori Fredrickson, the Chief Operating Officer of Vivio, and we're also joined by a couple of the leaders of the portfolios we'll be talking about tonight, the first being Megan McKinley, and the second, Roy Chastain. Megan is from Spokane. She's a volunteer with the local chapter there for Better Investing, and has been at this for quite a while, serving as a volunteer educator there in the Spokane. They refer to it as the Inland Empire, Eastern Washington State. Roy Chastain, similar story. He's been active with the Sacramento chapter of Better Investing there for a few years now, and I would consider both Megan and Roy to be examples of people that I get to meet on the road. Those of you who have had a chance to read the newsletter know that I talked about people from Wichita to St. Louis just recently, and we've got a bunch of these type of people out there, so I think you're in for a real treat tonight. We're going to talk about critical mass. We're going to talk about going green. The going green is kind of a reference to Roy Chastain's portfolio, which he refers to as Green Haven. As you know, at these sessions for several months now, we have been kind of leaning on this theme of the campfire that was given to us by Hugh McManus about a year ago, when he basically pointed out that campfire is a friend to hunters and gatherers over the centuries, and that we gather together to stay safe and to basically lean on each other for stuff, and hence the club meeting there in the middle. Many of you may know, or at least some of you may know, that I am a fan of nuclear fusion, not fission, but that's what the critical mass thing has to do with there on the right. That is critical mass as it relates to nuclear fission, but we're not going to be talking too much about that sort of thing. One last bit of housekeeping. If you would like copies of these slides, you can either get them at the Manifest Investing Forum, or you can send me an email, markr@manifestinvesting.com. Those of you out there that are Twitter people, you know who you are. You can track us at Manifest Invest at Twitter. Let's go ahead and get underway. A lot of very familiar names again here tonight. You know the drill. No investment recommendation is intended, even though we're going to talk about specific stocks. There will be opinions. Everything we do here is to demonstrate a method or a process or an approach to fundamental analysis and long-term investing. Everything we do here is for demonstration and for illustration only. So the bottom line is to, as you guys all know, it's up to you to do your own homework. Let's just pause for a moment. I got a kind of a kick out of Roy Chastain's email. We asked this question during our Common Ground session last weekend. What are investment clubs? And into that you should read, because it's not just about clubs. Read Portfolio Management. What are they all about, Charlie Brown? And in Roy's signature for his email is kind of an intriguing little moment there, and that's what I've included at the bottom of the slide. I think it's kind of a fascinating way to think about this challenge of taking care of a portfolio, building and taking care of a portfolio. And literally, little by little, we learn the art of being quite content with doing very little slowly. And that's from an actor in a BBC series. Roy, are you a big fan of that series? It's been about 10 years ago it's been off the air, right? Or do you just like the quote? And he may have muted himself.
It's actually on in Sacramento, but maybe we're 20 years behind the times. I don't know.
Is that right? You guys are in some kind of a time warp, and you're getting something.
Yeah, Saturday at 7 p.m.
Cool. It's a good quote, though. I mean, many of you have heard me talk about a cadence, or the reality that you shouldn't be taking sudden dramatic actions with portfolios. You really should just be kind of like aiming at some targets. We're going to cover that here in a few minutes, and just kind of whittling away over time. And if cadence works for you, fine, but I really like this quote. Being content with doing very little slowly. And one of the things we talk about a lot at Manifest Investing is many of the challenges faced by Wall Street itself is their apparent inability to follow that quotation. I mean, it's just a frenzy of activity. They think if they haven't bought and sold 10 stocks by, first breakfast break, they're not doing their jobs or something along those lines. I can't profess to understand it. Warren Buffett even says, some of you will remember a few months ago we talked about the dance card, and you've only got so many real investment opportunities during a lifetime of investing, and they seem to defy that out there. And sometimes it gets a little bit frustrating. Let's go ahead and get started tonight with the first portfolio. The first portfolio is a club. The club goes by the name Achieving Critical Mass. I love it. I love the image. It's a group of friends from Spokane. The current constituency of the club is 6 people, 2 guys and 4 ladies, although Megan shared that the club was larger and it actually had more men than women over the years. You can see that they were founded in 1996 and late February 1996, so they've been around 12, 13 years, 16, 17 years now, going on their 16th year. And here's a quick look at how they've done. The rate of return since those early days checks in a little bit on the low side, and we'll get into the details about that. But keep in mind, again, we always keep things in a frame of reference or perspective. The stock market's only gone up 5% in that time frame. So that trails by a couple percent. Now they've got a lot of company there, and we're going to be talking about that also. But what I want to point out, and I think here's where the story really comes tonight. They had kind of a tough start. We'll take a look at that here in a second. But since the year 2000, and they've been just kind of slugging away at this since the year 2000, if you measure their relative return, now that's relative on top of the S&P 500, it's plus 3% since 2000. So they had kind of a slow start, but since then they've actually been kind of ripping the cover off the ball and coming back ever since then. So we'll get into that in a little bit more detail. Here's a look at their year-by-year results. Achieving critical mass going all the way back to 1997. You'll see what I mean. During a period when the stock market was pretty hot, you see these blue tops here. That was back when men were men and snow was deep and returns in the stock market were that much per year, every year. Well, during that 4-year period, achieving critical mass kind of came out of the gates a little bit slow. You can see that they actually underperformed all of these first 4 years. So they literally underperformed the first 4 years. And again, one of the things we do tell clubs, we suggest with all our heart, be careful about measuring performance during that time frame anyhow. You really should be just getting in there, learning how to identify leaders, picking leadership companies, trying to accumulate them when they're on sale. But this was a little bit, I think there's a measure of misfortune or bad luck in there also. I also believe, if I had to guess, and again, the club is welcome to jump in and help me out here, I believe you probably got caught up in some of that end of the 1990s frenzy with some of the technology stocks and that sort of thing. Probably got involved with some stocks that did fairly well for you, but then got caught in that turn of the century Y2K thing and basically took this hit that we see here. There are an awful lot of people, you certainly shouldn't feel like the Lone Ranger. There are an awful lot of people in that camp. I believe, and this is personal opinion, I don't think that the National Association really prepared us very well for this time frame. We had a really hard time. I mean, I can remember talking about selling Cisco and Oracle back in that time frame, and there were people literally threatening to stone us at the time. I wrote an article about Cisco being the most overvalued stock in the stock market at a time when 99% of the professional analysts following the company had a strong buy rating on the company. So this kind of stuff was there and was impeding the performance of many people within the community, so I don't think there's any exception here. Well, fast forward here to starting with the year 2001 and going forward, you notice, well, here's one where they significantly outperformed the market during 2001 while the market continued to dive. Literally, the market continued to take a pretty good dive. These 2 years were 2 periods of pretty extreme outperformance, along with 2003 when they managed to outperform a hot stock market. And then again in 2004, they continued a 4-year winning streak here. Then they had a couple slow years, took a bit of a hit in 2006, actually outperformed the market during the Great Recession, even though they were down, outperformed it then, and then had a couple fairly strong years here. So what does that all add up to? And here's a way that you might look at it. we're basically looking at the annualized relative return going back to their founding, but we're only actually looking at the picture from 2001 through the last year, 2011. And you can see that that slow start led to them being down here somewhere in the relative return range. And again, that strong performance we were just talking about in the 2002, 2003 timeframe, vaulted them back into striking distance of going to a positive relative return. Now, they kind of chugged along for a few years, and then the performance kind of drifted down a little bit, heading into the period known as the Great Recession. Now, I'd like to take credit for, this is when I last visited Spokane, so I'm going to take credit for everything after that. And then I welcome the club to jump on and throw apples at me or tomatoes at me, but this is when I visited April 2007, so I'm going to take credit for a little bit of that. Maybe I gave them an idea or two. But as you can see here over the last 5 years, their all-time, again, since inception, annualized relative return has been moving definitely in the right direction. And this is the sort of thing that if they keep doing the right things, if they keep doing this over time, this will continue to drift up and hopefully into the land of positive relative returns. Keep in mind that since the year 2000, the club is beating the S&P 500 basically 5 out of 9 years, or 55% of the time. You keep doing that, maybe even a little bit more, it's going to be just fine over the long term. So it's just a little bit different way of looking at performance, spending a little bit more time on it than we typically do. We are going to spend a little bit more time at future sessions talking about this sort of stuff. But here's the portfolio that they currently have that's been performing actually quite well over the last few years. And you can see there's some real household favorites in there. And like many investment clubs, they have a pretty good stake in Apple, 14% of the total portfolio. But pretty strong portfolio from top to bottom. We were just talking about Cognizance has taken a hit here in the last few days. That probably explains, why the par is up where it's at. But some pretty strong representation in industry leaders and community favorites from top to bottom. A pretty hot performance in Buffalo Wild Wings has led to this. We're going to be talking about that in a few minutes. But from top to bottom, pretty good distribution sector-wise, and again, a lot of community favorites and companies that have been pretty well regarded by many of us here. Now, they do have just eight stocks in the portfolio. One of the things that I would recommend for the club is, you probably do want to get out here into the 12 to 16 range if you can. And again, I'm fully sympathetic to the fact that you're down to 6 members, but with the tools at our disposal these days, you really can, even all 6 can basically track the entire portfolio. You can assign stock watchers and all that kind of thing, but keep in mind that just like everything else in the world of investing, your portfolio doesn't know how many of you are involved. So, much like a stock doesn't know whether you own it or not, you really do want to be mindful of getting enough in there to take out the market risk situation. But this basically confirms that anywhere up in this range, you don't have any portfolio positions. With Apple being at 14%, your largest one, there isn't one that's completely dominating the portfolio, and there's nothing off the scale at the bottom end either. This is kind of the rationale for why you want to be in that minimum of 12 range. And again, it has to do with appropriate and prudent diversification. We typically teach it as try to aim for 16 stocks plus or minus 4. So you could go as low as 12, if you want to go with focused or concentrated positions. But in general, it's a pretty good idea to try to get within this range where this blue line flattens out and you really are dealing at that point really with market risk. So let's get started on taking a look at the portfolio, some of the elements of successful long-term investing. And again, I see a lot of very experienced investors here in the room tonight, and you guys would all echo my comments on this. I tend to think of long-term investing as a journey. I do think that it really does boil down to something no more complicated than a dipstick. If you know what type of things to check for, what things to design for, and what to monitor and maintain. And then we will be talking a little bit about best practices, much like we did in our Common Ground session this past weekend. Here's a look at the portfolio dashboard, and I've done something a little bit different in this case, I've taken out some of the columns. Those of you that are familiar with our dashboards, like we saw just a few slides ago, I've taken out all the columns except for what I would consider the primary three, the three that we've got graphed here. In the case of achieving critical mass, they're at a 13% projected annual return. Now the MIPAR, the median stock in the stock market, is out there at 8.5, so we would basically be trying to shoot for 13 to 18, 13.4 to 18.4, and you can see that's what's depicted over here. Here's the target range, and just a tiny bit short. I wouldn't even call it short. They're basically right at the low end of the target range. That's just fine. On quality, let's just give it a check mark. If anything, you have more than enough. You've got pretty good situation on the quality side of things. We generally counsel that you want to be somewhere in that 75 to 80 range if you can. You don't want to overdo it, but really good standing. On the growth side of things, again, a wonderful distribution of companies that add up to a 12% growth rate. Again, what we generally counsel is to get somewhere in that 11% plus or minus range for the average investment club, and they've done that also. So the nutshell version of a portfolio analysis on this particular portfolio, achieving critical mass, is everything's fine. A little bit more return would be a good thing, but everything is fine. Here's what I go to is when I'm looking at it and thinking about what's going on in the portfolio. Well, first of all, 14.5% cash, that's not too much. I mean, it's a little high, but it's in the current conditions, probably not too much as long as you're out there shopping and really hunting down opportunities as they present themselves. Again, nothing that you have to hurry about. I would be attempting to spend some of it if I could, but wouldn't hurry. I would wait to find appropriate opportunities. We've sorted the holdings here by their return forecast, so it's from the highest projected return to the lowest projected return. The ones up at the top, I think they're probably just fine. They're a little bit dicey, but not bad. Got some stocks in the sweet spot, but when we get down to the bottom here, Buffalo Wild Wings, that's the one we need to take a look at because the stock price has shot up. Basically, it could be a situation where the stock price perhaps is getting a little bit ahead of itself. And we sort of see that over here with the business model analysis or the visual analysis for the company. Take a look at, I believe the current stock price for Buffalo Wild Wings is somewhere up in the 80 range. So it's literally, we're about a quarter of the way through this year. So literally the stock price is somewhere up in this range, and it's been as high as up here. Okay, so up here in it literally got up into the 95 range for a while. I mean, just visually, I mean, we see here the price bars superimposed against the earnings per share. So you literally have the P versus the E. You're looking at the price to earnings ratio over time, and notice that the current price level is as far away from the trend line as it's been in quite some time. So that alone tells you that it's maybe a little bit ahead of itself. The real buying opportunities are when the price got down here and literally came down very close to the earnings trend line. So again, the distance from that earnings trend line is literally a picture of the price to earnings ratio over time. Right now, the PE ratio is somewhere up in the 30 range. 30. Now, it's down from where it was historically, but it's somewhere up around 30 right now. But not too far to range, but certainly not as attractive as it has been. Here's a look at the stock price chart using stockcharts.com. www.stockcharts.com. This is a free site. We are looking at about a 5-year profile of the company, and you can see that it's a stock that has had a lot of momentum. The 200-day moving average, the blue line up through the middle here, has been, real steady, very, very strong. The relative strength index did top out with the stock price up at the 95 levels. It did top out here just a few months ago, and again, we don't know what's going to happen after we see one of those, but again, what I've learned to expect, or condition myself to believe, is that in many cases after we see a condition like this, where the relative strength index is way up here above 70, we could get either a flat spot or a downdraft in price. Now that has happened. We've had a bit of a downdraft dropping down from the mid-90s to the low 80s, and I'm not sure where it closed today, but it was certainly in the low 80s. So again, this is not, from a long-term perspective, not the least bit surprising that they'd lose a little bit momentum, because it had it got way ahead of itself. In fact, there was a whole bunch of speculation that back in this point in time, right in this point in time, that they were going to begin to have some operational trouble, and they didn't. They did have a little bit of a slowdown in same-store sales, but not enough to bother anybody, and then they just completely blew the door off the next quarter. So just a fascinating company. Again, momentum perhaps went away here a couple of months ago. This is the type of company where I think it is prudent, especially if we get into a flat spot with this long-term trend for the price, this 200-day moving average, to really pay attention to these crossovers. And the reason I just bring this up is I just want to show that this is a stock that is capable of dropping from, in this case it went from 45 down to I believe 15 or so, literally in a period of a little bit less than a month. So that is the type of massive price drop that is possible. So anytime you're tracking a company like Buffalo Wild Wings, you have to be mindful that this has happened. That alone can be reason for using this high relative strength index above 70 as an excuse for getting out of it, or perhaps reducing a position or that sort of thing. And it's going to really come down to the overall portfolio. And for many people, it is 9.4% of the total. Could be a situation where some of it perhaps is sold to make room for some higher return stocks, or all of it. Again, it's going to be up to you. I think I'd be inclined to hang on to it, unless we really see a divergent situation. And I'll leave it up to you guys to study stockcharts.com and divergences. Literally, if it comes up and tops out and doesn't quite make new highs, that might be a time to think about a little bit. Here's a look at the Chronicle for Buffalo Wild Wings, and perhaps a little bit of an answer on when you may have been nudged to possibly clear the table. And again, we really want to reinforce that this decision is not made in a vacuum. In other words, it's not just about Buffalo Wild Wings. What does the rest of the portfolio look like is a pretty important condition also at the time. But when it did get up into that $95 price range, I will point out that the PAR literally did go negative at this point in time. So there was a period in time when it had an extremely high relative strength, the projected return had gone slightly negative, and if your portfolio was in the mood or was literally whispering to you, maybe we need to lighten up on this one, or particularly if your portfolio needs more return. This one doesn't. Achieving critical mass doesn't right now. But if Buffalo Wild Wings is in a portfolio that needs more return, that's a sell situation. Now, when it comes to stock watchers, and I know that Achieving Critical Mass tries to use the stock watcher type process, I believe, what are we watching for? What are you really watching for? And we kind of hinted at this a few minutes ago with Cognizant Technology. We're literally watching for changes in expectations. When we put together our business model analysis or the visual analysis for any company, we're including 2 years of forward-looking expectations. And what we're looking for is any signs of weakness in future earnings. So for instance, tonight Cisco came out and said our earnings are literally okay, maybe they even outperformed by a penny or two, but then they come back with, yeah, but 2013 and even 2014 we expect to see some downward pressure. And again, to the analyst community, to the professional investors out there, they're looking for damage to that long-term trend, impact or influence on that long-term trend. And that's what we're watching for. Is there a sufficient enough of a reduction or deterioration of expectations to cause our top line and bottom line expectations to take a bit of a downdraft? And again, obviously it's valid also in the other direction where we have an improvement in expectations. The other thing that you really want to watch is the projected profitability of the company. And in this case, we see profitability projections for margin. I know you can't see the numbers. Don't worry about the numbers. We're basically talking about a company that's had fairly steady profitability, even though they're in a very challenging business, the restaurant business. This has all been okay. And again, what you'd be watching for is any signs of deterioration in profitability or margins going forward. Again, big time red flag, especially if you start dropping down below historical ranges. You can literally just visualize the range there. If they start dropping below that, then that is something to be concerned about, and it will be reflected in the return forecast at manifest when it happens. Here's a quick look at the critical mass portfolio sector diversification. Nothing wrong with this at all. I mean, they do have a fair amount of cash. No surprise there. Pretty good distribution. A little bit of emphasis on technology, no surprise, but there's nothing wrong with that. Pretty good distribution across the board, despite the fact that they have a fairly limited number of stocks. So as they go shopping, I think I would be shopping for opportunities in staples and a couple other areas, but again, go where the market takes you and discover where the opportunities are. In that regard, I pulled up and did a quick stock search. This is actually from last night, where I literally went in and I searched by manifest rank, literally looking for manifest rank greater than 98. So we're shopping in the top 2%, the top 2 percentile of all companies that we cover. And the rank is literally a combination of quality and par. So we're basically taking those two, combining them into this manifest rank. I combine that with the Motley Fool Caspi. Then literally this is a sentiment thing. This is a sentiment. I'll just put an S here. Here we'll put I can't draw a Superman thing, but you get the point. This is a sentiment thing. In other words, what I'm asking for is I want to look at the top 2% of all companies that we find attractive based on the fundamentals here, but I also want them to be among the companies that are in favor by the Rhinos and other investors out there. So that literally filters the list down to the 11 that you see here. Some pretty interesting names here. I will caution you that with the next update, this one will go away. So we'll just cross it off. I love the concept of investing in Indonesia, so don't get me wrong here. But when this is updated, that will fall off the chart. So we're left with Hawkins, Quality Systems, Total. I would cross out Total because they have Exxon. So just cross out Total. AeroVironment, IPC Hospitalists. Now they have a bunch of, they actually have these covered a little bit, so that one may get a check mark against it. POSCO, I'm still having trouble warming up to Korean steel, but could be okay. This is one that was kind of a favorite a little while back, but there's some good companies here. Portfolio recovery is already in the portfolio, so we'll X that out. And then if you want to get into the death and taxes regime, there you go with Hillenbrand. But what I would literally do at this point, just to demonstrate the use of our worksheets, and we can actually take a look at this if we have a little extra time, is, what if we ran these through the gauntlet and added them to the portfolio? And that's what I'm showing here with our worksheet capability, where we can play what if games. I've literally gone in and added 50 shares of Hawkins, 50 shares of QSI, and 65 shares of AeroVironment. Again, why those totals? Literally to come in at these 4 to 5% levels, somewhere around $1,500 a piece for the 3 positions. Still leaves us with a little bit of cash to go shopping. And again, much like Roy's quote at the beginning, you don't have to do this all at once. We're just doing this for purposes of demonstration. But those added to the portfolio, converting some of the cash into these 3 stocks, which actually are pretty good studies right now, nets us a pretty good situation with the overall return of the portfolio. And here's the 2 side by side. The before condition, what we literally have done is gone in. We didn't mess up the growth, pretty much kept that the same, pretty much kept the quality on par with what it was. But what we have done is gone in and replaced the cash with 3 stocks with suitable returns, and we've literally tacked on a couple of percentage points to the overall projected return for the portfolio. So that's just an example of what adding these 3 companies can do to better position the portfolio from a return forecast perspective. So pretty cool stuff. And again, the club's doing fine. This is just for purposes of illustration. If it were my portfolio, this is the type of thing I would do. I would want to get it up into that minimum of 12 stock area and take care of it from that area, from that perspective. Let's go back to that discussion of performance a little bit, and I want to reinforce for some of you who may not have been with us on Saturday morning, we actually went through a more detailed analysis of this, but I want to put this concept of relative return into a little bit more perspective. One of the best relative returns we've seen from any individual in the last century of investing is Peter Lynch and Fidelity Magellan over this time frame, where over a 13-year period, he generated an incremental or a relative return of 13.4%. The actual numbers were something like 26 or 28% per year over that time frame, and this was above and beyond the S&P 500. So literally, here we are at 13 years and 13.4%. We gave Peter his own little honorary Rhino here to keep track of him in a red dot. The red dots are institutions. This past weekend was the annual Mecca to Omaha to celebrate this guy here, Mr. Buffett. Buffett, if you go back 20 years, and we're talking about the performance of the holding company Berkshire Hathaway, 1992 through the present, they've actually managed a 6.6 relative return. So again, 20 years, 6.6. These are both monster returns from both, and we like them both. By the way, this is somebody we will be talking about much more. Walter Schloss. He's got some returns that are even better than Warren, going up on 30 years. Wanted to take just a quick moment to emphasize a couple of things here. And one of the things I want to emphasize is you really shouldn't look at the impact or influence or results of any one year, any one single year. And what we're going to take a look at is the Legg Mason Value Fund going back to, and literally you can think Ronald Reagan. 1982 is basically when they started running this fund. Bill Miller was with the fund at its inception. And what Bill Miller is famous for is, well, first of all, kind of the opposite of what we saw from Achieving Critical Mass. When they came out of the gates, they basically outperformed the market the first 4 years by a massive amount. It probably brought in an infusion of all kinds of cash. And then you can see they had a real tough year with 1987, and then they underperformed again pretty badly in the recessionary times of 1990 and 1991. But starting at that point in time, he started a 15-year continuous run starting here of outperforming the market for 15 years, one of the longest streaks. In fact, it goes all the way out to here. One of the longest streaks that we've seen from any fund, any portfolio, be it institutional or club. So the 15 years of outperformance, you can see he's had a little bit of trouble, or I'll say a lot of trouble here in recent years. But here's kind of the way you look at that, and then kind of boiling it down into this annualized relative return concept. Again, relative return, we're looking at the relative returns since inception. They came out of the box red hot. They were actually way up here off the chart to the top side. Had that really tough time frame in 1989 through 1991, where they basically came back to earth, and then they began that 15-year run from here to all the way out to here, where during that period of time they built up a relative return since inception that actually maxed out at about 3.5%. So this was that magic run. Like we said, I don't think anybody else has equaled that in a long time. And then fairly mediocre and challenged performance here over the last few years, to the point where they've come down to pretty close to a 0% relative return going back to 1982. So I think some of you would find that interesting, that even though there's this 15-year run in here, I would have expected, at least my instinct would have been, for these numbers at this end to be up here, closer to let's say a 9 or 10% level, and they're just simply not. But he did manage to outperform the market for 15 years. And why do we set the context up? Just to make the point that, you know, when you're measuring performance, it is extremely important to keep it in context. You know, what is your relative return and how does it fit on this map? And again, this map is a display of blue balloons and red dots. The red ones are institutional portfolios, whether they're professionally managed funds or that sort of thing. And you can see here's Peter with the Magellan result. Here's Warren. Well, here's Walter out here. You can see that Walter's got some fairly special numbers. In fact, he had a fund that's somewhere up here also, which we may talk about someday. That's also Walter. Just incredible performance over that period of time. But also a few clubs that we've got interspersed here. Some model clubs in this area, the Brighton, Mid-Michigan model clubs. This is another Ken Kavulik club. And a couple other people we're pretty proud of, Susan Macholik and her Bower City ladies, Groundhog winners a few years ago. This is an investment club from Kansas, Nothing But Net. They've been perennially among our leaders. So you see it is possible to generate these very strong relative returns. And then you see that there are a few clubs. Now the Achieving Critical Mass has been on a path from down here somewhere and steadily improving. And like I said before, I really do expect that if they continue with the path that they're on, to end up somewhere in this positive return performance over time. Again, citing that over the last 12 years, they've been operating at this level. The other thing I want to point out is for every one of these red dots that you see up here that are in on the top half of this chart, there literally are going to be, when we do a scientific sample, at least 8, maybe 9 times as many down here below 0 or below 1%. So what you're going to see is just a bunch of red dots filling this all in. And I've actually begun doing that. I was literally picking mutual funds out of a Scrabble bag earlier today, literally randomly selecting funds and plotting them on this chart. And it's already starting to fill in with all these red balloons down here. So that's what you're going to see. So again, it's important to keep it in context. Oh, by the way, Mutual Club of Detroit, that's 60 years at plus 3%. Some pretty cool stuff there. Lori, do we have any comments or questions at this point?
No, I don't see any, Mark.
So everybody is ready to garden and they're being quiet tonight and they're just loading up for questions later.
Hope so.
All right, let's go ahead and take a look at the other portfolio tonight. I wanted to do this just to demonstrate. This is actually Roy Chastain's portfolio, codenamed Greenhaven. People have been asking, will we do individual investor portfolios? And we probably won't do it quite as often as part of this program unless I see an opportunity to underscore something that's kind of common ground for investment clubs also. But I really wanted to put this one together just to make a point that our findings with the National Association over the years were that literally the numbers were 14 out of 15. 14 out of 15 individual investors who were partners in investment clubs would go on to open and maintain an individual brokerage account after participating in a club, kind of taking some of the fear and mystery out of it. And what we want to concentrate on here for a little bit is what's important about that or what might be different. And here you see some of that. With an individual portfolio, you do have the difference of time horizon. In theory, an investment club has an infinite time horizon. Think about that. I mean, it literally has an infinite time horizon, so that you really should be operating as a quote-unquote club that will last forever, a portfolio that is built to last forever, you know, versus an individual who will have actual needs, be it the life needs to go with the you know, the kids going to college, kids getting married, people entering retirement, all those personal and individual life cycle needs that we have. And then also the risk tolerance for an investment club is something of a, you know, homogeneous mix, and it should be fairly optimistic, fairly willing to accept some type of risk, whereas individuals may be a slightly different story, and sometimes these two tie together, by the way. The risk tolerance and time horizon are related to each other. The other thing is you could be in a situation that's not listed here of preserving capital versus building it. And those are different considerations that don't come into the traditional investment club. And all of those questions can have impact on the target ranges that we set for the key parameters of any portfolio. So that's literally what's important, what's different. What is important, it's the same thing. You look at an individual portfolio much the same way, focusing in on the same primary design characteristics. This is one of Roy's portfolios, which he's dubbed Greenhaven, and again, subjecting it to the same form of analysis. Again, very quickly I go in and I notice, well, he's at 7.8% projected annual return. So the first question would be, you know, is he attempting to preserve capital? Is he doing some form of allocation? We'll talk about that in a minute. I also noticed that he's got one of his holdings, about 1% of the holdings within this particular portfolio has a ticker symbol Brew. Well, first of all, I like it. Hugh McManus should be here to celebrate this. The Craft Brewing Alliance is not a company that we cover, although we're going to try. We'll try to add it to our coverage because it's in Roy's portfolio. And we'll take a look at that one in a little bit more detail. A very small stake in Intel. Now, Roy did inform us in the green room that was because he had a mystery infusion of cash from an Intel dividend, literally a dividend reinvestment type situation where he purchased some shares of Intel after selling the position at one point in time and picking up some dividends after the execution date. Cerner, one that Roy wants to talk about, has the lowest projected return in the portfolio. So again, if we're thinking about improving the return of the overall portfolio, we have to look at Cerner, and then we also have to look at this situation of being 31% in cash or cash equivalents. So these are some of the things that we would look at for the individual portfolio. Here's a quick look at the Craft Brewing Alliance. Kind of an interesting situation, relatively young company, still relatively small in the $100 million revenue range that you see here, growing at a fairly decent clip. They actually produce the Red Hook Ale and Kona, I think it's Kona Brew or something like that, out of Portland. Company that has not been public for an incredibly long time, but it's been public these few years here. Their earnings are coming right up to speed. We also noticed that over time the earnings have been getting closer to the sales trend. That suggests and basically confirms increasing profitability for the company. Here's a look at Craft Brewing Alliance from the technical perspective, and again, we have a couple of potential buying opportunities. I'm not sure if you took advantage of one of these, Roy, but you can chime in if you would like and let us know how long you've held it. Go ahead, Roy.
I've owned it a couple of years, so it's probably your left arrow.
Probably back at this point?
Yes.
Got kind of attractive back in this time range. And again, you know, you heard us talking a few minutes ago about Buffalo Wild Wings and being concerned about when this gets too high, relative strength index above 70. And again, as we said then, wouldn't be the least bit surprised to see either a flat spot or a downdraft in price under that. Well, the opposite is true here. This is relative strength index below 30. And again, the opposite is true. We would expect to see perhaps a flat spot, but the potential for increase in price from a flat spot as it recovers from whatever situation has driven that price down into that bit of a trough. You can see there have been a couple of them here. Let's talk a little bit about, especially with individuals, and for those investment clubs that actually adopt the balanced investing where you have core and non-core assets. It applies to investment clubs that have made that conscious decision to participate in this sort of thing. It is appropriate and can be very prudent to, when market conditions dictate, to maintain what some of us would think of as a relatively high cash position. We saw that Roy's got 31% in cash in this particular portfolio. This is from the Value Line Investment Survey, their selection and opinion report. It's on the next to last page of this particular report. We talked about this on Saturday. They basically give their recommendations for, again, if you're in a situation where you're preserving capital or might be risk averse, or simply recognize the reality that sometimes it's a good thing to have cash on hand when massive buying opportunities present themselves. Well, here we're talking about them being at roughly 35% for a current situation. So again, if you're practicing the balanced investing prescribed by Mr. Nicholson, it can be appropriate to have, 25, 30% of your portfolio in cash if you really do think the market is a little bit topped out. Or again, it can be a function of capital preservation depending on who you are and that situation. So again, that type of number for an individual portfolio is not as unusual. With clubs, it's a little different. Again, think back to that theoretical, almost infinite life cycle situation or time horizon situation. That's why the numbers that we generally toss around for investment clubs are a little bit lower than the numbers that you see here. Let's kick around Cerner for a few minutes. I said we've got about 15 minutes or so left. Cerner is the position in Roy's portfolio that has the lowest projected return. As we were talking before we got started, Cerner is kind of the company that back when it became apparent, back in this time frame, when these information services companies in the realm of healthcare were going to basically be like flies to light. They're literally going to be quite attracted, and literally we've seen a lot of momentum in Cerner. A lot of the institutional rhinos really like Cerner as a company to turn to in this area or this space. And you can see that their results have been pretty strong. And this is another case where you can see the two lines are converging. That's a sign of increasing profitability. Here's section 2A, slightly modified to be after tax. We do everything after tax at Manifest. But the net margin over this time frame has been going up and up and up. And that's why these two lines are converging. One of the reasons anyhow. And you can see that the analyst expectations for 2012 and 2013 are still for increasing profitability for the company. So fairly intriguing situation, company growing in the 10 to 12% range based on the trends that you see here. Pretty strong stuff. Here's a look at the technical picture for Cerner, and why might there have been a little bit of weakness here lately? This is one of those divergent situations we talked about where the relative strength index has gone up above 70 and it's having a hard time going up quite as high. That makes the rhinos nervous. It makes them skittish. So even though all the fundamentals are in place over here, you can see the assumptions. Here's 11% growth. Here's 14% margin. In order to justify a fundamentally based return forecast that's any higher than somewhere close to zero, you literally would have to either ratchet these up, and I don't think you saw anything on that previous slide which justified that, or you'd have to go with a higher PE, and I don't think many of us in the room would want to go with a much higher average PE. So from a fundamental perspective, it's probably a bit overpriced, hence the return close to zero. Now, that doesn't mean the rhino still won't chase it, and that's what we mean by this relative strength index and monitoring the momentum, because this stock has a lot of momentum. Notice the blue line again, much like Buffalo Wild Wings. But again, monitor for the drops. This one, by the way, is not as vulnerable to Buffalo Wild Wings for that huge price drop we talked about a few minutes ago. So this one's a little bit less nerve-wracking, if we see this type of stuff start to happen again. Not to say it can happen, but just a little bit different behaving animal than Buffalo Wild Wings. But based on what I'm seeing here, Roy, wouldn't be the least bit surprised to see this thing get stuck in the mud a little bit, trading range or worse, for a while going forward. So you have to decide.
I'm comfortable with that.
Yeah, and if you're fine with that, obviously the portfolio is probably where you want to be. One thing that I thought we'd do, jumping out of the PowerPoint for a second, is just go to that second opinion, if we want to underscore it, for Cerner. Just to double check and kind of underscore, I'm pulling up the value line sheet on Cerner and showing here that they're also in fairly modest return expectations for Cerner. And with that, Roy, I thought I'd give you the opportunity, if there's any one of these you want to talk about a little bit. I thought this was an interesting display of somebody bearing their soul about decisions that they've made.
Full disclosure.
Yeah, what have you learned from many years of investing in this type? When you sell something, What lessons would you share?
Sometimes you can be too clever by half. And,
Okay.
but I mean, I feel I've done better. I've learned a lot, especially with Strayer. And in selling that, that's part of why I have so much cash. I haven't figured out what to do with it. But,
Okay.
not only did I buy at the wrong time, everything looked great, and then the feds entered into the picture, and the price dropped. But as it kept dropping, I kept buying, thinking, you know, it's going to turn around. Well, that was that proverbial falling knife I caught. So I've learned not to do that, or at least I hope I've learned that.
Yeah, and that's something that I've been talking about the last few days on, you know, even, I don't remember the company that was involved. You know, when you have one of these falling knife situations, sometimes you have to give it some time to sit there and vibrate. I think it was Quality Systems. We can actually go and take a look at that here in a minute. Go ahead, Roy.
Well, and the other, because of that, you know, if it's really bad news, maybe you ought to bail, which is what I did with eBix. I made a great, you know, money, but there was all that bad press, and I decided, you know, I could sleep better at night if I sell it. So that's what I did.
And did the bad news actually turn into anything? Here's a look at a stock chart for eBix. You're talking about selling somewhere back here, and it actually did take a fairly significant drop.
Mm-hmm.
Well, you can see that it dropped from 28 to 13. So if you protected yourself from that, that could be a good situation. What else would you share about?
Let's see. What was that? Yeah, I sold it at 22. So that's just, well, and the other thing which you and I have talked about for about a year with hogs, I decided that you can't trust the books from China, but I don't want to leave the Asia completely. So I'm invested in China through Yum and McDonald's.
Sure.
Because I feel I can trust their books, but and I'm just going to ride them to the finish line.
Very
so
cool.
That's pretty much it.
So it's kind of fun to see somebody soul searching here a little bit, and you're certainly not alone with Buffalo Wild Wings, with people who have sold it and then watched it go back up, and that one's been frustrating to a few people. And again, just some summary comments there that you guys all know. Lori, do we show any comments or questions, or does Megan have any comments or questions at this point?
There's no questions. Oops, wait a second. Here's a question. Laura Scott is asking if, when you're looking at asset allocation, would you recommend, and this would be for a person, combining all your accounts, your IRAs, your 401ks, Roths, and brokerage accounts, or should you do asset allocation for each account individually?
Well, I mean, again, that's in the eye of the beholder. I typically like to keep accounts at multiple brokers, just not because I'm maxed out on my federally insured limits on it or anything like that, at least not yet. Well, I hope to have that problem someday. But that can be a reason for some of you to have multiple brokerage accounts. Sometimes I identify accounts with purpose, like the kids' education stuff was at one broker. And then you can literally just basically do that, have your accounts. I wouldn't go overboard and have 10 different brokers, but you know, why not have 2, 3, 4 different accounts if you like the service you're getting from them and they meet your needs.
I think, okay, I guess she's clarifying a little bit. She's talking about when you're looking at the percent you hold in stocks and the percent that you have in cash, would you combine all those together to look at that, or would you look at them one at a time?
That's where you definitely do want to take a look at it as one big picture. You know, if you've got a purpose account, purpose-driven account, like a college education thing or something like that, you can obviously put separate parameters on that, depending on, you know, time horizons and all that sort of thing. But overall, I think you really do have to stack them all up into think of it as stacking up 5 dashboards and then basically thinking about them collectively at the same time that you might be thinking about any one of them for, Cy Lynch likes to call them buckets. You might have buckets depending on separate needs, but you still have to keep the buckets all kind of choreographed also. Anything else?
I don't see any other questions right now. Oh, somebody's asking, they say they have a sizable amount of guaranteed cash value in their life insurance. I'd always considered that to be their no-risk bucket. I assume they might be talking about some sort of a whole life kind of insurance.
Yeah, it probably has a cash value on a life insurance policy. And again, I'm not an accountant or a official financial planner anyhow. But yeah, that is an area, kind of a holding area for many people that have whole life insurance accounts. Yeah, nothing wrong with that. Again, keep that, keep that in mind as you're totaling up your assets. I kind of go against the grain and think of the real estate that I live in as part of that portfolio too. Even though that's not easy to do in Michigan here for the last few years. And it's actually performed in ways that I never would have predicted, and I don't believe anybody else would have either. At least not in Michigan. I'm fully aware of what happens on the coasts, but not Michigan.
So Megan has given you a little input that you gave them some more ideas to look at for stocks and also to search. And she said they're going to have to suck it up and take on more stocks to watch. Yeah,
I didn't want to be too harsh, but if you think about one of the beautiful things that Nicholson gave us, we actually hammered away on this weekend with Lori. Just loves it when I talk about the fill in the blanks. What really matters in the analysis of any company. Well, how's it going to grow? How are they going to make profits? And what's the PE going to be? Are the 3 things. And if a group of stock watchers can't handle those 3 things for 2 or 3 companies, I think we can. I know we can. I've met you guys. I know that you can do it. And those literally just have to gauge, just like it says here on this slide. You basically figure out what are your expectations with respect to those 3 key milestones for any one of the companies or all the companies within the portfolio. And then you be vigilant for threats and opportunities along those lines. And that really is one of the best things you can do as a stock watcher. And again, for those of you that are wondering what I'm talking about, we actually had a series of presentations. I think they went quite well. Some of you were there. This past weekend, if you go to Manifest Investing and you go to the Events tab and you click on Recorded Events, Kurt has made this very easy to get to these guys. I'm talking about a couple of presentations here that the audio-visual archived recording is there for group investing, common ground, and I actually had the lowest expectations for that one. That turned out to be one of the better sessions of the morning. And then there's this one down here, Focus on the Forecasts. What do we care about as a stock watcher? What do I care about? What should I be watching? And then part of this group investing thing was, what are some of the best practices for the members of an investment club or individuals taking care of their own portfolios? Literally watching the stocks. What do you watch? And then, of course, up here, the searching for stocks in all the right places. Just simply went through and talked about some of our favorites. So again, if you go to events on the Manifest homepage and look over here for past events, you literally come up with some of these recordings. I would encourage some of you to take a quick look at them. For those of you that are in clubs that really wonder about how we do some of this stuff, there's some getting started sessions here. I thought we had our stock blast here, but they're not here. We actually have some 8-minute descriptions of how we look at companies like Stryker, and then we also did one on Matthews. If you wanted to do a study, Hillenbrand came up on the stock search results tonight. Hillenbrand versus Matthews might be something that you consider as comparing the two side by side. Any other questions?
Yeah, somebody's asking, Jane Gilbert is asking whether you would say it's better to take dividends in cash or add them back to do dividend reinvestment for the stock, in a stock.
Well, again, it's a matter of personal preference. I will tell you that I do a presentation on basically establishing that that's not what rule number 2 was about, the reinvest dividend things. I think reinvesting dividends is important. I prefer to select where they land, where they end up. I literally don't, really, sometimes you get trapped into it by some of the programs that we follow as individuals and clubs, where you have to invest back in the parent stock, reinvesting back into the original company. But I'm not the biggest fan of that. I just think
I can reinforce that, because especially nowadays when it doesn't save you commission money to be doing that, it just becomes a record-keeping nightmare for many clubs. You just end up with many, many, many lots of little teeny-weeny amounts of shares with all kinds of decimal points after them, and it's just crazy. I think it's, just from a record-keeping standpoint, it's just not worth it. It was a great idea when we were paying $200 commissions to buy stocks, but
right.
I would totally reinforce what you're saying from a different perspective too.
Yeah, and I just come at it from the more strategic aspect of, let's say Roy was faced with a couple $1,000s worth of dividends, rather than deploy them into the individual companies where he might be reinvesting in, say, a Cerner. I'd rather take the $2,000 and invest in the companies up here at all times. And one thing I didn't mention, Roy, is that if you expect the cash, if you think you're going to be shopping for quite some time, you might give some thought to like a Dodge and Cox income fund. DODIX is an example of that, as a place where there's cash. That would put a little bit more percentage points on here without introducing too much upside or downside volatility. You might have to settle for a little bit of downside volatility, but if you look at the long-term track record of DODIX, it hasn't gone down very often. And
that's good. I've always wondered what to do with my cash, and the amount has fluctuated, but with the situation both worldwide and in this country with the election and that, I just haven't been tempted to spend it.
Yeah, and
keep my powder dry.
There's this other notion of sell in May and go away that Lori and I have talked about a little bit here over recent days, and it sure seems to hold out. That it seems like every year now we're kind of pre-programmed into a slump, and what that says to me is don't necessarily go away, but certainly it is a time where you can accumulate a little bit of cash and be more selective and really watch for wonderful opportunities. One other thing,
last year when the market fell in August, I doubled up some of my holdings, and then in the fall I sold them to get back even. So that covered a lot of errors.
One other thing I did want to point out, because it came up in the issue of Cerner, if you take a look at Roy's portfolio, if it were me, and he's looking at things a little bit differently than me, I would be very tempted to take Cerner proceeds and invest in Quality Systems. And if you want more ammunition on that, what I would point the audience to is if you go into forums at Manifest and you go into stocks, this question actually came up a number of times yesterday, and I see Dan Hess posted on it this morning. If you click into Quality Systems in the stocks folder, we actually went through and did a little bit of analysis on what might be happening, because we can't find any bad news. The only bad news was this Allscripts MDRX actually took a bit of a dive last month. They got caught doing some nasty stuff. No signs of degradation yet in Quality Systems. You can see they've taken a pretty good hit, even though there's fundamentally no weakness. Could be a potential buying opportunity. And I basically just added up to the situation in Europe that's making the rhinos all nervous, along with this crossover. You can see there is a crossover situation between the two moving averages. You can study up on what can that possibly mean to a company that's gone a little bit flat. And literally the nutshell answer is the rhinos are just nervous. The rhinos are literally nervous about this. They're nervous about Europe. They're nervous about a competitor in trouble. They're nervous about the competitive relationship to Cerner. They're just nervous about everything. And you can see that, well, there's your business model or visual analysis. And Dan actually gave a fairly complete analysis of, you know, some of the Rhino characteristics behind it. So I would just direct everybody to take a look at the manifest forum in the stocks folder and maybe take a close look at that. And again, I would come at it from the perspective of if this were mine and no longer Roy's, first of all, Brew would be added within the next day to the coverage by manifest. But I would be looking at possibly accumulating quality systems and perhaps lightening up on Cerner, if not getting rid of the position completely. Just because of the massive trade, the swap between a projected return near 0 and a projected return near 20 for quality systems.
So take my 99% gain and go home, huh?
Yeah, it could be prudent. Hard to say. I mean,
Okay.
Cerner is actually hot, very good company. It's an outstanding company. No question about it. All right, Lori, we're standing at about 9:38, so we'll do a last call for questions. If there's anybody out there that has something on their mind.
Bill Thompson was suggesting Roy look at Oracle also and Microsoft.
Because he's probably getting
maybe adding, I guess, increasing his percentage holdings in those.
Yeah, what Bill is basically saying is there's not a whole lot of Oracle here, not a whole lot of Microsoft. Yeah, and Oracle's actually out with, they've been a little bit disruptive here lately too, so they probably took a bit of a hit when the rhinos are nervous. Cisco Systems, by the way, will be down in the $17 range tomorrow morning when the market opens. So that also might be one to look at if you still believe in the fundamental story behind the company.
Yeah, to be honest, I've been tempted to sell Cisco and Oracle. What's kept me in it is your high par, but I'll take a look at those. Microsoft, you know, being an Apple fanboy, it's kind of hard for me to go too hot and heavy into Microsoft.
Well, there you go, getting all emotional again.
Yeah, you always get to that at Microsoft in the Challenge Club.
It's a fault.
Yeah, it's okay as long as you know you got it.
Perfect.
All right, well, with that, I'm going to go ahead and I want to do one last thing here tonight other than pull up the final slide again. And I just want to do a 30-second tribute to a friend of mine who passed away this weekend. Many of you know her well. Her name is Amy Rausch Nielsen. She wrote the Beginner's Corner article in Better Investing magazine for several years. She's been an active contributor to iClub Central for the last few years, but at the age of 42 or 43, she lost a long battle with cancer this past weekend. The reason I bring it up is this 1, 2, 3 blocks. Every time I see that, I think of Amy, and she just made a fairly massive contribution over a life that was way too short to a community of investors. And I know many of you have talked with her. I mean, I literally had an interview on the table that didn't happen with Amy, and we'll miss her dearly. And just again want to say God bless you, Amy, and you definitely fought a good fight. It's time for you to rest. So again, Amy, thank you. And with that, we'll go ahead and say good night. We'll shut down officially. Stick around for a few minutes, but thanks for everybody for attending, and everybody get out there and hug your mother for Mother's Day. Good night, everybody.